Something that is rarely talked about in the investment communities is leverage risk. Everyone loves talking about buying real estate, cash flow, number of doors, growing a portfolio. These are all sexy topics and they get us so energized and excited. However, leverage risk is one of these boring topics, but really, really important topics that you as an investor need to pay attention to. And here is what I mean. At the end of the day, the type of loans you take on your portfolio and the extent of leverage you take on your portfolio will play a huge role in determining your success as an investor. Sometimes I find that investors are talking about a mortgage at the property level. Should I go fixed or should I go variable? How much money can I get and buy this property with the least amount down? And while obviously it is important to talk about financing at a property level, you want to really zoom out and look at money and leverage at a portfolio level. And I rarely see investors do that on a regular basis. What you want to do is, at least on a quarterly basis, you want to zoom out and you want to look at all of the mortgages that you've got on your properties. You want to look at when your renewals coming up. Are they all coming up at the same time? Are they coming up close to each other? Because anytime a renewal is up, there is an opportunity to revisit that mortgage. And if you're coming out of a low rate into a higher rate, that's risk. The other thing too is if you're taking high leverage on multiple properties at the same time, let's say because you've bought with private money or you're renovating, you really want to assess how long is your exposure going to be using that type of money. And what I mean by that is, it is one thing to take a private mortgage at a 90% loan to value on one property, or a high private first with unsecured money to renovate. And it's another thing to do it on multiple properties. And the longer you sit on a high leverage, the higher your exposure is to market cycles. And when things go wrong, now you've exposed a big piece of your portfolio to eventually negative influence because of that high leverage. I've seen, unfortunately, investors lose their entire portfolios because they sat on that high leverage for a long period of time. Also, again, as part of the zooming out is looking at your interest rate risk. So you always gotta keep an eye on what's happening up there. What is happening in the environment you're operating in? Where are the interest rates going? And nobody has a crystal ball. But we can all make an educated guess based on data and following experts. I personally follow multiple senior rate analysts in the industry that spend day in and day out studying rates, so I can make an educated decision for myself and for our investors. Again, investors are busy being in the forest, really chasing the exciting deals, the cash flow, but you really need to zoom out and see the forest, and you need to see what's happening in the environment you're operating in. Are interest rates going to rise? Are interest rates are going to stay stable? Are there changes in the lending rules? How will that impact your portfolio, not just one property? So my whole point out of this video is to say, you want to be strategic. You want to look at the portfolio. You want to be proactive in terms of how you manage risk, and in particular leverage risk, because if you don't, you're going to be busy being busy, building, your cash flow and properties, but without that discipline of zooming out and talking to advisors who can help you see the big picture, you're really exposing the wealth that you're building. And unfortunately, I have seen this happen in the 2023 cycle.